We retired from the 9 to 5 last year at the ages of 27 and 31. But before we made that decision, the biggest question we had was, how much money do we actually need to retire young?
Like many people, we started with the 4% rule, the common rule of thumb that says your financial independence number is 25 times your annual spending.
But there's an important catch. The 4% rule was designed around a traditional timeline of around 30 years. If you retire in your 30s, 40s, or 50s, your money may need to last 40 years or longer, and that changes the math.
Before retiring, we read widely, ran projections, and tried to understand the theory as deeply as possible. But now that we've actually been retired for more than a full year, we have a much clearer sense of how our spending changed in retirement, which risks feel more real in practice, and which assumptions were much harder to make than expected.
So in this video, we want to share a practical 7-step framework for figuring out how much money you need to retire early. We'll start with the basic principles, then show how they apply to our own situation.
And if you're interested in more of our early retirement story, check out our channel page for more. Let's get started.
Everyone thinking about retirement needs to understand the 4% rule. It's a simple rule of thumb for estimating how much money you may need before you can stop working. If you need $40,000 per year, your target portfolio would be around $1 million.
The idea is simple. In your first year of retirement, you withdraw 4% of your starting portfolio. After that, you continue withdrawing the same amount each year, adjusted upward for inflation.
This 4% figure is commonly referred to as the safe withdrawal rate, meaning that withdrawing this percentage of your initial portfolio each year with inflation adjustments has historically given retirees a strong chance of making their money last until the end of their retirement.
It's a really helpful starting point. It turns retirement planning into a simple formula. But it is not a one-size-fits-all answer. It was built around a number of specific assumptions, some of which may not fit your situation well, especially if you are retiring early. So, to decide which safe withdrawal rate makes the most sense for you and how much money you need each year after retirement, there are 7 major questions to consider.
The first question is, when do you plan to retire? This matters for 2 main reasons. Number 1, the classic 4% rule was designed around a 30-year retirement. That makes sense for someone who retires at around age 65 and plans for their money to last into their 90s. But early retirees need their money to last much longer.
Financial blogger Early Retirement Now has tested this directly. He found that with a 50-50 stock and bond portfolio, a 4% withdrawal rate had about a 95% success rate over 30 years, but only a 65% success rate over 60 years. In other words, 4% may look safe for normal retirement, but much less safe for a very long retirement.
He also found that for a portfolio with a fixed 80% stock allocation over 60 years, the lowest historical safe withdrawal rate was 3.14%. Now, that does not mean everyone must use it. As we'll explain in question 5, there are ways to adjust your annual withdrawals, which can increase your withdrawal rate. So a rough framework might look like this. 3.25 to 3.5% may be reasonable if you're flexible and willing to adjust spending when the markets are bad. 3% to 3.25% is more conservative and provides higher confidence.
The second reason your retirement date matters is sequence of return risk. When you're not selling your investments, the order of market returns does not matter as much. If the market falls first and recovers later, or rises first and falls later, you end up in the same place if the average long-term return is the same. But retirement is different. Once you retire, you're regularly withdrawing money from your portfolio. If the stock market crashes early in retirement, you may be forced to sell investments after they have already fallen in price. That can cause permanent damage because the shares you sell during the crash cannot participate in the later recovery.
This is why the first 5 to 10 years of a retirement are so important. A Vanguard paper gives a great example of this. It compared 2 retirees with the exact same portfolio and similar long-term returns. One retired in 1973 and the other in 1974. The difference was dramatic. The 1973 retiree ran out of money after just 23 years, whilst the 1974 retiree still had about a quarter of their original portfolio left after 35 years. It's all because 1973 was an especially bad year for the stock market, and that one bad starting year had a huge impact on the retiree's long-term outcome.
The market valuation at the start of retirement can affect future returns. If stocks are very expensive when you retire, future returns may be lower, and the risk of a painful early retirement downturn may be higher.
As we're making this video in June 2026, the US stock market is very expensive based on CAPE, a commonly used valuation metric. When CAPE is high, stocks are expensive relative to their long-term earnings. Historically, higher CAPE levels have often been followed by lower long-term future returns.
In June, the S&P 500 CAPE ratio has been hovering around the low 40s. As reference, its long-term average is around 17.39 and its historical maximum was 44.19, near the peak of the dot-com bubble. That does not mean the market might crash tomorrow, but it does mean US stocks are starting from a very expensive level compared to other markets.
For us, we're planning for a retirement window of around 60 years or hopefully even longer. Given our long horizon and current high equity valuations, we chose a conservative 3% withdrawal rate.
How much do you need to spend each year to live the life you want? I've checked every single expense I've made over the past 7 years, and that has definitely helped me understand where my money goes and what my consumption habits look like. But that is not enough to accurately estimate post-retirement spending. The real question is not how much you spent while you were working, it's how much you expect to spend in the lifestyle you intend to live after retirement. And for us, that estimate was actually quite difficult.
Before we retired, I was living in London and Christine was living in Hong Kong. Using two of the world's most expensive cities as our benchmark didn't make much sense because we fully intend to take advantage of geo-arbitrage and living somewhere where our money can provide a much better quality of life.
The challenge is that we still don't know where we want to live long term. Over the past year, we've been exploring around the world, trying to find a place that suits us best. And until we decide where to settle, it's difficult to know exactly how much we will spend. On top of that, as we shared in the previous video, not having a 9-to-5 job actually saves us money in many ways. So there are a lot of moving parts.
Because of this, we had to use an indirect reference. We asked ourselves, what are the places where we could realistically see ourselves living long term, and how much would it cost to live an average lifestyle in those places? Neither of us has a particularly expensive taste. We don't need luxury, and we'd be more than happy with a comfortable, ordinary life.
Rupert is from New Zealand and England. I'm from China. He's lived in Portugal, Russia, and Mexico, and I in the US and Hong Kong. In the past year, we've also visited Thailand, Spain, and Japan. So by now, we have a rough sense of what it costs to live in many different parts of the world.
Based on objective data and our personal experience, these are our rough findings. In many parts of China, Southeast Asia, and Latin America, we believe that we could live very comfortably as a couple on around $30,000 per year. With $40,000 per year, we could extend that to Portugal, Spain, and many other parts of Europe. And with $50,000 per year, New Zealand and Australia become realistic options. We also currently have no plan to buy any properties.
Of course, there are also some big ticket items to consider. A major one for us is children. We do plan to have a child, and honestly, we have no idea exactly how much that will cost. But children only create additional expenses for a certain period of time, likely from birth until they turn 18 or maybe 22. For that reason, we don't include child-related costs in our regular fire budget. Instead, we've set aside a separate amount specifically for that purpose. We've explained in another video how we are planning for a child, both financially and mentally. We've set aside $300K for child-related expenses, which could generate roughly $20K per year in cash flow for 22 years.
Healthcare is another important consideration. We're really lucky that our home bases have high-quality public healthcare systems, so if anything major or serious does happen, we do have a safety net. And with everyday healthcare needs, we would choose to stay in places with reasonable public healthcare or affordable private care. Those costs should be covered within our regular annual budget.
There are still uncertainties, of course, but for us, the goal isn't to calculate a perfect number, but to find a realistic spending range that gives us enough flexibility and comfort. The third major question, what does your investment portfolio look like? Which comes down to three things. First, stock bond allocation. Second, diversification within asset classes. And third, US versus international exposure.
These choices matter because your portfolio affects both your expected return and your risk exposure, which directly influence what safe withdrawal rate is appropriate for you. For our exact investment portfolio and our results from last year, you can check out this video.
Let's start with the stock and bond allocation. Many people assume that more bonds automatically means more safety, but in retirement math, especially for very long retirements, safety is not only about reducing volatility, it is also about protecting yourself against longevity risk, the risk of living so long that you run out of money. We need enough equities to help our portfolio outrun inflation and withdrawals over time.
But the opposite extreme, going 100% in on stocks, is also risky. At first, 100% stocks may look attractive because stocks have higher expected returns over the long run, but retirement is different from the wealth building phase because of, again, sequence of returns risk. Bonds give you a source of money to draw from during major stock market downturns, so you do not have to sell too many stocks at the worst possible time.
For early retirees, the stock-bond allocation is especially important. Over longer retirement horizons, portfolios with higher equity allocations, such as 75 to 100% stocks, have had much higher success rates historically.
For us, when we first retired, we started with an 85-15 allocation. Now we are gradually moving toward 90-10 by withdrawing only from our bond portfolio and selling some bonds to invest in cryptocurrencies and venture capital opportunities.
9-10 was our target for 4 major reasons. First, we have a very long retirement horizon. Second, we use a relatively conservative withdrawal rate, so we have more room to take equity risk. Third, we are flexible with our spending. Our fixed expenses can be quite low if needed. Fourth, we have a high risk tolerance. We have both experienced portfolio drops of 30% or more and stayed pretty calm through them.
That last point is very important. Even if the math says an 80-20 or 90-10 portfolio might work well, the real question is, can you actually stick with it when the market crashes? During the global financial crisis, the S&P 500 fell about 57% from peak to bottom. If you had around 1 million invested, that would have dropped to about 430,000. Would you really be able to avoid panic selling?
Don't answer hypothetically. Look at how you behaved during real market declines. The market fell about 34% during the 2020 COVID crash and 25% in 2022. How did you react during those periods? Did you stay calm and keep investing, or did you constantly check your portfolio in fear? Your ideal stock and bond allocation is not just about what looks best on a spreadsheet. It also has to be something you can actually live and sleep well with during a real crash.
The second part of portfolio design is diversification. Building retirement around a few individual stocks is risky. Yes, if you had gone all in on the biggest tech companies in recent years, you would have done extremely well. But that kind of success comes with very high concentration risk. Your financial future depends too heavily on a small number of companies. If they disappoint, your retirement plan can suffer badly.
That kind of risk may be acceptable if you are young and still working with decades to recover, but in retirement, the goal is not just to maximize upside. Risk management becomes more important than trying to double your money quickly.
That is why we invest almost entirely in index funds, which allow us to own thousands of companies all at once. This removes company-specific risk because our portfolio no longer depends on whether we have successfully picked the few big winners. At the same time, we still get exposure to the long-term equity premium.
Diversification also matters with the stock portion of the portfolio. The original study behind the 4% rule was based mainly on a simple portfolio of US large cap stocks and intermediate term treasury bonds. Later research found that adding US small cap stocks helped raise the withdrawal rate to 4.5%. Adding US mid cap stocks improved the result further to 4.7%. And a 75-25 stock and bond portfolio that included large, mid, and small cap stocks pushed the withdrawal rate to as high as 4.9%.
So why would this happen? Large, mid, and small cap stocks are basically shares of big, medium-sized, and smaller companies. Their performance is not directly correlated. Because they do not all move in exactly the same way, diversification can make the worst-case scenarios less damaging. And when it comes to retirement, the worst-case scenarios matter a lot.
Given the incredible bull run the US stock market has had over the past 15 years, it's easy to understand why some people argue that there is no need to invest overseas because international stocks might only drag down your returns.
And to be fair, this view does have some theoretical support. The conventional 4% rule is based on historical US market data, and the US stock market has performed unusually well compared with most other developed countries. One study looked at asset class returns across 38 developed countries and found that a 65-year-old couple who wanted a 95% chance of not running out of money could safely withdraw only 2.31% per year, and that is far below the traditional 4% rule.
The takeaway is clear. If you live outside the US, investing only in your own domestic stock market can be very risky. But that doesn't automatically mean putting everything in the US stock market is the best choice either.
We tested this using a website called portfoliocharts.com. Suppose you have a 90-10 portfolio with 90% in US stocks and 10% in US bonds. That gives you one set of safe withdrawal rates. But when you diversify across international markets, the safe withdrawal rates increase in a meaningful way.
Why does this happen? Because which market made the most money over the full period and which retirement portfolio had the lowest chance of running out of money are two completely different questions. A safe withdrawal rate is not determined by the best average return. It's determined by the worst case scenario. A 100% US stock portfolio can have excellent long-term returns and still produce a worse safe withdrawal rate if the retiree happens to start during a bad period for US stocks.
And this is where international diversification can help. International markets do not move exactly the same way as US stocks. By owning a globally diversified portfolio, you reduce the risk that your retirement depends too heavily on one country having a good sequence of returns at exactly the right time for you. As we explained earlier, the US stock market is currently very expensive relative to international markets. That does not mean international stocks are guaranteed to outperform, but it does make the global diversification even more attractive.
As shown in our investment portfolio video, we invest in globally diversified funds such as SWRD or EIMI. For us, the possibility of earning higher future returns is great, but that is just the icing on the cake. The more important goal is not running out of money before we die, and for that, we are willing to sacrifice some potential upsides in exchange for a more resilient portfolio.
Question number 4. What is your tax situation like? This is an area that people can easily overlook when planning for retirement. The number that really matters is not your gross investment return. It is how much money you actually get after the tax. Before choosing a permanent home, you need to understand where you will be a tax resident and how that country taxes capital gains, pensions, dividends, wealth, and other assets. A poorly planned tax situation can significantly reduce your retirement income and may even change which country is affordable in the long term.
For example, Spain has wealth and solidarity tax. Portugal does not have a broad wealth tax, but investment income and capital gains are commonly taxed at 28%. New Zealand taxes offshore portfolios by attributing annual income even when you have not sold investments or received cash. Hong Kong is extremely attractive from an investment tax perspective because it has no capital gains tax, but that advantage has to be weighed against its high cost of living.
And to be honest, this is not something we considered enough before retirement. Unfortunately, it is now having a real impact on where we choose to establish our permanent home. So if you're planning to retire early, especially if you want to move internationally, taxes should be part of the core retirement calculation.
Question number 5. How flexible is your spending? Some expenses are difficult to change in the short term, such as a mortgage. If you have children in private school, there may be some flexibility, but moving them to a public school could be disruptive to their education and personal life. On the other hand, expenses like overseas holidays are much easier to cut or postpone when money is tight.
This matters because the 4% rule assumes that your spending increases automatically every year with inflation. In real life, however, people do not spend like robots. When markets are doing badly, retirees can often reduce non-essential spending for a while. Because of this flexibility, researchers have found that using a flexible withdrawal strategy, often called a guardrail strategy, you can increase the safe withdrawal rate by 0.5 to 1%.
So how does it work? You begin with a target withdrawal rate, such as 4%. Instead of withdrawing the same inflation-adjusted amount every year, regardless of market conditions, you set upper and lower boundaries around your withdrawal rate. These boundaries are called guardrails, warning signals that tell you when to cut or raise spending.
Let's walk through an example. Suppose you have 1 million saved and decide to start a 4% withdrawal rate. So your starting withdrawal is $40,000 per year. You then set 2 guardrails around the starting withdrawal rate. Upper guardrail, 20% above 4%. Lower guardrail, 20% below 4%. This gives you a withdrawal range of 3.2 to 4.8%.
Rule 1. Reduce spending if the withdrawal rate gets too high. Now imagine your portfolio falls from 1 million to 800k. If you continue withdrawing 40k, your current withdrawal rate becomes 5%. This is above the upper guardrail of 4.8%. That means you're withdrawing too much relative to the size of your remaining portfolio, which triggers a spending cut. The common rule is to reduce the withdrawal amount by 10% to 36k. This cut helps protect your portfolio during a difficult market period.
Rule number 2. Increase spending if the withdrawal rate gets very low. Now, imagine the opposite happens. Your portfolio grows from 1 to 1.3 million. If you are still withdrawing 40,000, your current withdrawal rate becomes 3.1%. This is below the lower guardrail of 3.2%. That means your portfolio has grown enough that your withdrawal has become very conservative. A common rule is to increase the withdrawal amount by 10% to 44,000. This allows you to enjoy more of your money when your portfolio is performing well.
Rule 3. Stay the course if you are between the guardrails. If your current withdrawal rate remains between 3.2% and 4.8%, no major adjustment is needed. In normal years, you may still increase your withdrawal with inflation. However, if markets have performed poorly, you may choose to skip the inflation increase for that year. This is a smaller adjustment that helps avoid putting extra pressure on the portfolio.
Overall, a variable withdrawal strategy is more realistic than a fixed rule because it reflects how people actually behave in retirement. The more flexible your spending is, the easier it is to use this kind of strategy successfully.
Question number 6. How much money do you plan to leave behind? This matters because under the 4% rule, a retirement plan is considered successful as long as the portfolio has more than zero left at the end of the retirement period, whether there is millions left or just $1.
For us, the answer is relatively simple. We do not plan to set aside additional money specifically as an inheritance for our child. Our main goal is to make sure that we have enough money to support our own retirement, maintain our independence, and avoid becoming a financial burden.
That said, under the 4% rule, more than 2/3 of historical scenarios finished with more than double starting wealth. And since we're using a 3% rule, the ending wealth could be even higher.
So our approach is flexible. If decades from now our portfolio has grown far beyond what we need, we would be happy to share more with our child or donate it to causes that we care about. But if there is less money left at the end, we are also comfortable with that. We believe that care, support, and the education that we provide to our child in non-financial ways will be more than enough to help them build a self-sufficient and fulfilling life.
Question number 7. What are your backup options if things do not go according to the plan? Do you have a pension or social security that becomes available after a certain age? Would you be willing to go back to work if necessary? What skills do you have? And how employable would you be after taking several years or even decades away from traditional employment?
For us, these backup options are an important part of the overall plan. Christine has some mandatory retirement contributions from the years that she worked in Hong Kong, and I continue to make social security contributions in Portugal. We treat these as extra buffers rather than including them directly in our portfolio, especially given the fragility of social security schemes over the long term.
If you do need to include these as part of your portfolio, one very useful tool we recommend is the Early Retirement Now spreadsheet. It allows you to put your own parameters and create a more tailored simulation based on your specific situation. We will include the link in the description box.
Another valuable backup for us is geographic flexibility. We have established multiple citizenships or residence options across the UK, New Zealand, Hong Kong, mainland China, and hopefully soon the EU, which gives us the option to move somewhere with a lower cost of living if needed.
In terms of work, it will probably become increasingly difficult to return to our old industries the longer we stay out of traditional employment, but we do believe it is likely that we will earn some income in the future. With YouTube, part of it is that we genuinely enjoy content creation. It is a meaningful post-retirement project that helps us to stay connected with the world. Another part of it is the possibility of generating some extra cash, but we're not counting on any active income to support our retirement plan. Any future income is a bonus, but not a necessity.
All FIRE calculations are based on historical data. They can help us make better decisions, but they cannot give us guarantees. There is no spreadsheet that can remove every possible risk from life. So for us, the goal is not certainty. The goal is clarity. We want to understand the biggest risks well enough to make a conscious trade-off between safety and freedom, between financial security and actually living the life we want to live.
This is why we have chosen a 3% safe withdrawal rate, a high equity investment portfolio, and a flexible withdrawal strategy. None of these choices guarantee success, but together they give us enough confidence and peace of mind to sleep well at night. Ultimately, we would rather use the middle decades of our lives when we are the healthiest, most active, and most able to enjoy the world to live in a way that feels meaningful and true to us, rather than keep postponing freedom in pursuit of a perfectly safe future that may never exist.
That's it for today. Thank you so much for watching. If you have any questions, leave a comment. And if this video gave some value, please give it a like and share it with a friend who might find it helpful.
And if you enjoy thoughtful conversations about financial independence, slow travel, and designing a life beyond the 9 to 5, don't forget to subscribe. We will see you in the next one. Bye.
Bye.